G'day everybody, welcome back to a new video.
Yeah, it's been a while since we've uploaded our last video, so here's that.
It has been.
So today we just wanted to have a little chat about the state that the market's in and how long-term investments and short-term investments can be affected by the state of the market.
Absolutely. There's three things we want to touch on today. The first thing is rand cost averaging when you've got a debit order running along every month.
On top of that, your long-term investments minus your short-term investments, and how the recurring debit order will compare to something like a lump sum investment.
And then about the lump sum investment, we want to just chat about the ups and the downs of the markets and sell zones and hold or no sell zones.
Okay, so we've put together this little presentation just to illustrate a few points regarding your short-term investments or your long-term investments or investment principles in general. It's important to understand that the values and the portfolios are completely fictional and predetermined. You know, we've made up the numbers just to illustrate a few points. This doesn't constitute as financial advice to any individual portfolio, but it's just there to illustrate the principles and the investment strategies that we're trying to portray.
All right, so let's jump into rand cost averaging. So basically how this works is it just shows a simple graph of when you start to buy units at R1 a unit, and every month or every year you buy a unit but at a lower price. So in the middle of the zone, you will see that maybe your units have even dropped to 50 cents a unit from R1. Now, obviously, this can be quite scary because you might have put in 6,000 Rand over a term of 6 years or whatever the case might be, and now your fund value is sitting at 4,500. But what we're trying to illustrate here is that you're actually getting a lot more units at 50 cents a unit that you're getting at R1 a unit. So as long as you keep buying through this dip, and then you'll be fine, because if the markets just pick back up and go back to, let's say, R1 a unit, then at the end of the day, your investment's rand value will even be up quite a bit. So if I can show you an example of this, is when we look at this.
So basically what this table shows, it's based on the graph in the slide before. The green block over here shows how the investment value is based on a 12,000 Rand lump sum investment, whereas the blue shows the value of the investment if we had to make 1,000 Rand payments over a 12-month or a 12-year period. So we can see in the beginning of the period, we've bought 12,000 units at R1 per unit. And here, every period we're buying 1,000 Rands worth of units, but this table here shows you the unit price. So we can see that we're increasing the amount of units here as the unit price drops, and it'll then show the cumulative the amount of units that we have at each point and the value of those units.
So here you can see that, let's say you've over a number of 12 periods, which can be 12 years, you've bought in 1,000 Rand a year. So after 12 years, you've put in 12,000, and your fund value is actually sitting at 16,912 Rand. This just means that your unit price went from R1 all the way down to 50 cents and back to R1, just that dip. You just kept buying and you've made money at the end of the term. So that's basically what we call rand cost averaging. As long as you keep buying and keep that debit order active, you'll buy through those dips, and the market doesn't necessarily have to pick up a lot for you to benefit from this at the end of the day. As long as you just keep buying in the dip, you'll get a lot more units. You can see here in the middle, you can see that there's 2 months where you got, or 2 periods where you got 2,000 units for the same price, where in your first month you only got 1,000 units. So the key is to buy and not to sell during the times where our units are low. All right, so we now looked at a debit order where you buy on a different period every time, but there's also the other side of things where you buy in with a lump sum. So in this scenario, we're looking at a option where you've bought into investment with 100,000 Rand. So Now all of a sudden the markets drop. Your investment of 100,000 have dropped to 80,000 Rand. But this is what we call the no sell zone or the hold zone. So your first instinct is again to sell because this is a bad investment in inverted commas and you've lost money. But at the end of the day, we need to kind of stay away from that instinct or that first reaction and know that this is a hold zone. You've got 100,000 Rand in there. You've bought, let's say, 1,000 units. You still have 1,000 units. Units haven't gone anywhere. They're just worth less. We just need to wait at this point. Now, this waiting game could be any period of time. It could be as long as 4 or 5 years. So that's the thing that we don't know. We don't know how long this period will last. But at the end of the day, it can only be a year also, and then we will bounce back. So then we get to the zone where we want to be. We want to be in the sell zone. So you also got on the other side an investment where if we start here with 100,000 Rand, it could go up to 120,000 Rand quite quickly. And then a lot of the time you might think, oh, this is an amazing investment. I want to put in more money or I want to keep my money. But we need to be careful that we don't go and then buy in the sell zone because this, again, in inverted commas, is a good investment. So we need to be very careful of what our instincts tell us as a first reaction, and be very conscious of where the sell zones are and the hold zones, as you don't want to obviously sell when we in this area here, because if we sell there, you realize the loss, and at the end of the day, that's not what we want to achieve.
This is an illustration of an aggressive investment versus a safe or a conservative investment. The biggest determining factor of what kind of investment that we're looking to put our money in is the term that we've got. So this, as you can see on the bottom, this is taken over the space of 1 year. So if we chose to invest in the aggressive portfolio and a couple of months after we start the investment, we say we need to access the money, but at one of these points where the investment is sitting lower than the conservative investment, it would be a bad time to sell. Obviously, if we look at a period like this, which is just a couple of months later, that would essentially be the right time to sell. But the nature of the investment is very volatile. So as an investor, it's very difficult to tell when these low points or when these high points are going to be. So if we're looking over a conservative or a short-term, short period of time, we want to invest in a conservative investment where your capital is more conserved. The goal is capital preservation as opposed to capital growth. If we look at the same portfolios over a longer period, we can see this is a period of 10 years as opposed to just 12 months. Here we can see at the beginning is that short-term period that we were talking about just now. But as time goes on, as the years go on and the investments grow, we can see the big gap between a conservative investment and an aggressive investment. Now, this aggressive investment would be ideal for something like your retirement annuities, where there's a 10-year or more investment term, whereas this more conservative investment or the conservative option is more of a short-term plan. Essentially putting money away for a rainy day. All right, so hopefully after that brief explanation, you can feel a little bit more secure about your long-term investments and a little bit more knowledgeable about how to invest over the short term, especially when it comes to funds that you need liquidity in, or investments that you need liquidity in, and how to invest over the short term.
Yeah, no, 100%. So that's always the thing, that you don't want to sell when your rand value is down. I think that's the most important part, because as humans we tend to get emotional about things and we want to sell as soon as the markets drop and your rand value is down. But at the end of the day, you've got the same amount of units sitting there. We just need to wait for those units to pick up again. Yeah, exactly. So if you have any questions, pop them down in the comments. Pop us an email as well. Our details are always in the description below. Thomas with the tagline: like and subscribe.
Cheers, guys.
Cheers.